I think it is a scary proposition. So I was pregnant when we raised. We raised at the end of 2022. We closed a round and I basically gave birth 4 weeks later. So I was very pregnant while I was raising.
Hi everyone, I'm your host Rohit Bhargava and you are listening to episode 201 of the Startup Playbook Podcast, a weekly series where I sit down with successful tech founders, investors and operators to unpack their journey, lessons and insights to help current and future entrepreneurs. The voice that you heard a little bit earlier was that of our guest for this episode, Cheryl Mack. Cheryl started her journey as the CEO of Startcon, which was Australia's largest tech startup conference at the time. She now works across a range of different projects, including the Pillars, 361 Angels, and the First Cheque Podcast, but she's best known as the co-founder and CEO of Aussie Angels. Aussie Angels is a platform that helps angel investors invest into startups via syndicates. And to date, over 1,700 angel investors have invested over $23 million through their platform. In this interview, we covered a range of topics, including the importance of brand, marketing, and storytelling, how to get started with angel investing, what founders should look for when deciding to add an angel investor onto their cap table, what investors really mean when they say they're looking for good founders, markets, and opportunities, and much more. Without further ado, here is my interview with Cheryl Mack. Hi, Cheryl. It's been a long time coming, but welcome to the Startup Playbook Podcast. Thanks so much for taking the time to be on the show today.
Oh, I am so excited to be here as a listener and just like knowing you in the ecosystem. I'm so happy to be here.
Yeah, appreciate you making time before you've got to hop on a flight. But Cheryl, I feel like most people know you in the ecosystem, but for those listeners that maybe aren't as familiar with you and your background, do you want to share a little bit about your story and what got you here today?
Yeah, for sure. It's a bit of a journey, but I'll try to condense it. So you may notice that I don't sound Australian. That is because I'm Canadian. I landed here about 10 years ago. I started a company called Startcon. We ran the largest startup conference in Australia for about 4 years. That was nuts. Like 4,000 people showed up and they all wanted to learn how to run a startup and get investment. And then a couple of years ago, I started angel investing because I was just like so ingrained in the startup space and realized that was a really tough journey to go on. And especially 5 or 6 years ago, I was trying to get into the space. It was a bit of a boys club, still is, but less so now. And I found it really difficult to get into deals. I found it really difficult to understand the space. Nobody really shared a lot. And so I made it my mission to make it easier for anyone else who wanted to start angel investing. And that's how I started Aussie Angels, was because I really wanted to create a more accessible avenues to access this asset class, which is early stage investing. And yeah, we just had people who wanted to come along for the ride. And now we've got like 35 syndicates that operate on the platform.
Amazing.
I'm also a venture partner. I run 361 Angel Club, which is a quarterly event for founders and angels to get together. And I also run a podcast as well. Not nearly as cool as yours, but we're
a very cool podcast. Do you want to share a little bit about what you and Maxine do?
Yeah. So again, kind of fitting with that theme of wanting to educate the next generation of investors, we started a podcast called First Cheque, as in when you're writing your first check or you're writing the first check to a company, either one. And so it's call them angel curious all the way up to emerging fund managers.
Yeah, very cool. I'll make sure a link to the podcast is into the show notes of this episode. So many threads to pull on, but I want to go back to growing up in Canada. So I think I shared with you, I actually spent a little bit of time in Canada. I was very young, had my first birthday there and lived there for about 2.5 years. But what was growing up in Canada like and sort of coming to Australia? I remember from a conversation you said that your intention was only to be here for a little while and then you ended up sticking around. What was that kind of journey like of being, not only coming into an emerging startup space, but being new to the space itself?
Yeah. I mean, Canada's a beautiful country. It has a lot of opportunity, but it also has stagnated a little bit. So the ambition originally was to come to Australia for 2 years. We're like, yeah, we'll go live somewhere else in the world and, just explore a bit and then come back and buy a house and a baby and, do all the settle downy thingies. And then 2 years on, we're like, oh, well, actually there's a lot of opportunity in Australia. Like this is a great place to live and careers were taking off. So we're like, well, let's, what about another year? Okay. And a year later, it's like, well, what about another year? Okay, well, and it just spiraled. And here we are over 10 years later. But when I first landed in Australia, I really wanted to make a point of like getting super ingrained in the ecosystem. So I just reached out to every person that I mildly knew or had heard of in the startup ecosystem and said, hey, can we meet? Like, I just landed. I'd really love to learn about the startup ecosystem here in Australia. And within 2 weeks, I'd met pretty much everyone. I met Murray Herps at Fishburners at the time. And he introduced me to a few more people, but 2 weeks in, I'd pretty much met everyone. And to their credit, and still to this day, I would say that the Australian ecosystem is very welcoming, very collaborative, very happy to make introductions. And I really, really appreciated that. And that was part of why I think I was able to just get so involved so quickly. I also will say that the Australian ecosystem, like scale at which it ramped up from that time, like I landed January 2015. That's, we're going on 10 years in a couple months from when I landed. And like the rapid change I've seen over that 10 years time is crazy. Like think about the number of funds we had back in 2015, like 2.
Yeah.
And now we've got, I went to Venture Down Under and there was 130 there. Like that's a lot of change in a very short period of time.
Yeah. I think still we kind of compare ourselves a lot to the US and everything's kind of happening there. But, I guess for, I remember the early days of Startcon. I was at Startup Vic back then. I remember Startup Vic was the only organization putting on monthly events now. And now I was speaking to someone this morning and they were just saying like the calendar's so insane. There's multiple events on every single night. And so
you could easily go to like 10 a night.
Easily. But again, something I wanted to pick on for, especially for people that are very new to the ecosystem, it can be a little bit overwhelming, especially if they spend a lot of time in corporate space where a lot of the feedback that I hear is like, oh, like, why would people respond to me? How do I sort of reach out? Like, it's just a very foreign concept to them in terms of how to build those sort of connections based on what they're used to culturally inside different environments. But any advice for people that are listening that are potentially new to the ecosystem and just trying to get an understanding and like learning how to connect? And even, as you said, I remember 10 years ago, like you could reach out to 20 people and that was the ecosystem. Now it's a little bit different. Cool, I met everyone. And, people are busy and there's a lot more noise. So any advice on how to both approach it, but also how to effectively, I guess, get people to respond through cold reach outs?
I find that like so interesting when you say like, why would I reach out? Why would people respond to me? On the flip side, like, why wouldn't they? There is so much to share, and I would say most people are genuine about wanting to help. Sometimes they don't have enough time, and I do have to decline meetings sometimes, but I think the value in creating those connections just far outweighs the downsides to declining those meetings. So I will try to say yes as much as possible. I think if you are reaching out to someone in the startup ecosystem, be clear about your ask and why you were reaching out to them and what you want from them. And if it is to pick their brain or to understand their role a bit better, then there's nothing wrong with that. And that's totally fine. We see that a lot. I would say that the startup ecosystem, and when I say the startup ecosystem, I mean like founders, investors, what we call ecosystem builders. So people who run co-working spaces, people who run podcasts related to the startup space, people who run accelerators or who are adjacent to startups or provide services to startups, such as startup lawyers or accountants. All of these people are very, very connected, but they want the ecosystem to grow. It is in all of our best interests to create this kind of like rising tide floats all boats. And so I'm always of the opinion, if we can drag more corporate people over to the dark side, I'm like, yes, 100%. Please come over here. I would be happy to tell you about the ecosystem. And most of us are like that.
Yeah. Again, we kind of spoke about this a little bit earlier, but the ecosystem was very different back then.
It was.
I remember the incredible events that you used to put on with Startcon. And again, do you want to share a little bit about, I guess, your experience through growing and building Startcon into, what was the largest conference in Australia at the time?
Yeah, that was such a nuts period. So I joined a company called freelancer.com when I first landed in 2015. And because I had run the Startup Grind chapter in Vancouver, when I landed in Sydney, they were like, do you want to run the Sydney chapter? And again, like there was not very many monthly events, as you know, right? And so that was one of them. And so I started running the Sydney chapter. And because I was doing that, I got invited to this dinner, which was basically a whole bunch of like really high profile tech people. I think Mike Cannon Brooks was there. And I sit down across the table and Matt Berry, the founder and CEO of freelancer.com, which is the company I just got hired at as an account manager. And he sits down and he looks at me and he goes, and he kind of looks sideways. He looks at Mike Cannon Brooks and he goes, yeah, that makes sense. And looks somewhere else and there's Rod from Zero or something. And he's like, yep, that one makes sense. And he looks at me, he goes, why the fuck is this? Sorry, I'm not probably allowed to swear. He's like, why is this girl here? We just hired her as like some account manager. We got to talking that night. And then the next day he pulls me into an office. He goes, hey, so like you've got some like startup event marketing experience, right? I'm like, yeah. And he goes, cool. So we just acquired this conference called SidStart. It loses $100,000 a year and it's pretty terrible, but do you want to run it? I was like, well, I mean, now that you've sold it.
So well.
So I did. I took it over. We rebranded it to Startcon. That very first year, I think he gave me like 2 months notice on this. He's like, cool, you're taking it over. And also I want it run in December. And it was like August. So I was like, okay, perfect. That first one, I think we had 1,000 people showed up. But then each year it just grew so quickly. And I think it was because there was nothing else like it. And we really put time and energy into designing the story around it. And that was unheard of in the like startup / just even in the event space at the time, that like somebody would think about what is the story around this event. So we chose a theme every year. And fun fact, if you know, my LinkedIn profile is me with a unicorn hat on and I have unicorns everywhere. It is because one of the themes, I think it was the second year we ran it, was death to unicorns or something.
Love that.
And we had giant unicorns everywhere. And so people still give me unicorn things. I'll be like at an event and like someone will come over and be like, hey, I found this unicorn pencil and I thought of you. So here you go. And all of that was because we brought storytelling and marketing. And like Startcon was successful because I'm good at marketing and storytelling, not because I was good at running an event, but we did run a really good event.
So just to maybe unpack that a little bit, when you say that you kind of gave it a story, what does that actually look like practically?
Yeah, so each year we chose a theme. I think the first one was software is eating the world. And because I think it was a play on one of the things that like a big tech investor had said. So that was the first one. And we like had Pac-Mans eating things. And the second one was death to unicorns, because it was like I can't remember what the like content was, but it was always to do with like what was happening in the broader world's startup space. And by bringing this like theme into it, so like the design of the website changed every year. We told the story of this is the type of content you're going to hear this year, and it all kind of fit under this theme of at the time, you know, death to unicorns or whatever it was that we chose that year. And people ate that up. They loved it. And that was the story of why are we running this event? Why are we bringing you speakers? Why are we pulling these people together? And like all the branding matched like across the whole venue, and the speakers that we brought in, the topics that they chose. So it's like you're telling mini stories, but it's all comes under this larger story. And that just wasn't something that was done.
What do you think makes for a good topic in that? So I guess the flip of that is fell into running a marketing agency for a few years. And I remember, you know, part of getting founders to kind of talk about things is they get sometimes a little bit, not necessarily founders, but marketing teams, let's say, get a little bit conservative in terms of messaging because you don't want to put particular people offside with things, and you want to be...
We've all seen the when it goes wrong.
Yeah. But you know, I guess from a death to unicorns as an example, right? Like
it's
I guess
pretty bold.
People, it's pretty bold. What was that, you know, I guess when you went through that process each year of kind of deciding what the theme was and those sort of things, what were the criteria that you sort of looked for, or how did you sort of decide on what would be the right theme for that particular year?
We looked a lot at what was going on in the broader global startup ecosystem and how people, like what the general sentiment was of like what people thought about unicorns. And I think at the time it was concerned that unicorns weren't going to be able to survive, that we were going to this like depression and that all the unicorns were going to die, and it was all about being a cockroach. So we kind of played on that in that particular year. I remember that year most because it sparked this whole like Cheryl unicorn on brand thing. But we would always just sit down and like it would be like a day long session where we'd put like 6 of us in a room, and by the end of the day we're like, we just have to get to a theme, and we'd just go through like what has happened in the world in the last 6 months, what do we think is going to happen, what are the trends that we can play on. And it had to be bold, it had to be something that like people would get a little bit polarizing over. And Matt Berry is a very polarizing person, so he just it always had to be something that like he almost could be like, no, I don't care. And just did not give any F's about things. And so I spent a lot of that time also managing polarizing relationships.
It's definitely fun to follow on Twitter. You know, I think an interesting aspect of what you just kind of said is the importance of kind of keeping your ear to the ground as well. So it's not like you're kind of pulling themes out of thin air of random things. It's very closely sort of understanding what is the sentiment, what are people talking about, what are they concerned about, what are they caring about in that particular moment. Helps drive the focus for that particular theme for that year.
Oh yeah, 100%. I think that is, like, to pull that thread a little further, I think that is really relevant for our ecosystem in general. Like, if you are an investor, if you are a founder, I'm not saying spend all your time reading about your competitors, but keeping your ear to the ground and understanding what's going on in the broader macroeconomic sense, as well as what's going on in your broader ecosystem, can be really, really valuable and pull out opportunities. VCs tend to do this, where they will sit down every year and think of, like, what are the themes we want to focus on this year? And when I ask them, but you invest, like, for example, Airtree and Blackbird, and I'm like, well, you invest in everything. Like, why do that? And they were like, it is because when an opportunity comes along, if we have done the research to understand that segment already, then we can make decisions much quicker because we don't have to do the research at that moment in that particular deal. A deal comes along and we have already educated ourselves in that space. We can get excited about it quicker, we can understand it quicker, and we can make decisions quicker, which sometimes means the difference between getting into a good deal and not.
What does that look like for you as an angel investor? So, and I think that's one of the challenges. We were both on a panel just yesterday.
Yeah.
And, one of the things that we were kind of talking about was sort of content and storytelling and what that's like when you're trying to do that across the board, when you have a team, but when it's just you as an angel, how do you sort of think about that for yourself when you're angel investing?
Yeah, for me personally, it's about choosing themes and sectors that I can invest in and sticking to those so that I can keep my ear to the ground on those themes. So, for example, I exclusively invest in B2B companies. I'll look at anything B2B, so not just SaaS. I'll look at fintech or marketplaces, but I do draw the line. It has to be B2B. So, like, no B2C aspect to it. I'll talk to founders like, yeah, we have a B2B option. I'm like, yeah, but you currently have a B2C option, and I'm just not interested in that. And then within that, I focus on HR tech, marketing tech, and fintech. And so that means that I can really try to keep my finger on the pulse in those particular B2B fintech, B2B marketing tech, B2B HR tech are sectors that I can, like, read blogs on and keep track of who's doing what in that space. So I think focus as an angel means that you're actually able to do some element of that. Of course, if I had a huge team and could task them with researching all day long, awesome, but I don't. And so that allows me to do some level of that without taking up too much of my time.
Yeah, it's interesting because I guess, like, everyone's got a different approach and thesis towards it. Because for us, I guess we're, from Playbook Ventures perspective, we sort of invest very agnostically, and I'd say probably half our investments have some form of B2C element for us. But, that is more opportunistic to a degree as well, because we know that there's not a lot of investors in Australia that kind of go after those types of opportunities. And so we're definitely a lot more selective and have specific criteria for B2C companies. But for us, it's more, we just think that there's an interesting opportunity there. And so we kind of get to play in that area.
Oh, there absolutely is. I think B2C investors have their pick, right? Like, because so many of us just don't do B2C, then when good companies come along, you have your pick, and you're not really fighting and elbowing and, being like, nah, get out of here, this is my deal, because it's like there's only a few of you, and so you're able to get into some really good deals. And objectively, Australia has actually produced some great B2C companies. And up until I think it was the end of the GFC, B2C companies were responsible for the vast majority of unicorns that were created. It's only in the last 12 years that shift from B2C has moved over to B2B. But if you look in developing countries and across Asia, you're still seeing so many B2C companies that are becoming unicorns rather than B2B.
Yeah, I think the kind of moral for us was there's opportunities everywhere. And so, as an angel investor, it's kind of more understanding what is the lane or the strategy that you want to sort of play in. Yeah,
there's no right or wrong answer here.
There is absolutely no right or wrong. I think some people focus on they've spent 20 years in climate tech and so it just makes total sense for them to have that as a particular area of focus. And for others, it's just more kind of understanding what the right approach is.
Yeah. I've talked to angels who are like, no, I'm agnostic across anything. All I do is, like, I talk to the founder, and if I think the founder is excellent, then I back that. I don't need to understand the sector. I don't need to understand the market. It's like, I just bet on the founder. I'm like, great. If that's your strategy, fantastic.
How has your, strategy evolved over time? Because, again, one of the things that you mentioned on the panel, which was also kind of a little bit similar for us with Playbook Ventures as well, is we intentionally tried to stay very quiet for the first 12 months or so, just because for me personally, I didn't want us to lean on just the podcast. I wanted to prove that we knew what we were doing and we could sort of pick the right companies. But what was that approach like for you when you first started getting into angel investing, and how has your strategy, if at all, evolved and changed over time?
Oh man, it's changed so much. I I wasn't very intentional about keeping quiet, although it was a purposeful decision. I think, and maybe a lot of listeners can relate to this, I didn't feel like I had permission to be an angel investor yet. And I didn't know when the line was, but I didn't feel like I had crossed the line yet. And objectively looking back, it took somebody telling me like, no, you've made 10 angel investments in the last year. Like, you are an angel investor. You are objectively more active than some of the other angels that I know that are angel investors. And it took someone else telling me that very directly, that I was like, oh, okay, thanks. Like, now you've given me permission. I will like tell people that I'm an angel investor. I will change my LinkedIn headline. I will like, but I actually don't think that I needed that permission. And so if there's anyone else out there that is looking for that permission, please know that I am officially giving you permission to be called an angel investor. So yeah, that changed a lot. And my investment strategy has also changed a lot. So the first few investments that I made, I think, were very focused on the product and the technology. I get excited about the idea and the opportunity, and I did not do nearly enough due diligence or time, I guess, with the founder. And that's probably the major thing that evolved very quickly. Actually, probably not very quickly, has changed the most, is now I spend way more time with the founder.
Yeah. Do you mind kind of sharing what that process looks like for you now when you're personally deciding to invest in a company?
Yeah, so it often starts with a quick 20-minute call. That's so that I can meet with a lot of founders. So the very first call I have with every founder is just a quick 20-minute, like, let's get to know each other call. Often I'll ask a few questions about the company and the problem, and like, actually, most of it is based on the founder. So why are you doing this is the biggest question. And what have you learned? What's your background? Like, I really try to understand them. And if I feel like there's a vibe there, in the sense that I feel like they are the right person for this particular problem, and that we are getting along in a way that it feels like we could possibly, maybe, potentially, hopefully work together, then I will let them know that on that call and say, look, I'd love to book a second call. That second call is usually a 45-minute call where I will go into the 3 things that matter most to me in terms of getting to conviction, meaning getting to a yes. And those 3 things for me are founder or founders, problem, and market size. And so I will go into questions like, who are you as founders? How do you learn? How do you tackle challenges? If you don't understand something, or you're looking to expand into a new area for a business, like, tell me how you go about doing that. Tell me about challenges you faced, or like, where have you disagreed with each other and how have you resolved that conflict? These are the types of questions that I just didn't think to ask in the early days. And one of the biggest reasons why companies fail is actually founder breakups. And I've seen it. Like, I've invested in 32 companies individually so far. And of the 4 companies that have completely failed, 2 or 3 of them had founder breakups. So it is a chunky reason as to why companies fail. And so I focus a lot more on that now. On the problem side is like, how painful is this problem? How often does it come up? What does it cost your customers in terms of time or effort, or like, what's the cost of this? I'm really trying to understand, is this a really painful problem that people are going to be willing to pay to solve? And on the market side is like, how many potential customers are there that experience this problem? How often do they experience it? How much are they willing to pay to solve this problem? Any evidence of any of those things? And then like, how many of them are there in Australia, globally, in Western countries? And I kind of build up from there. If they have a market size slide, I will actually ask them, break down for me how you got this TAM number, and have them walk me through the math. And sometimes I'll go into their spreadsheets as well and understand. For me, those are the 3 areas that I really need to understand to get to conviction. There's ancillary things, and I'll ask about traction and sense check the business model, and often I don't even ask for a product demo, like, because I've actually found one of the very first investments I made, I got a product demo and I got way too excited about the product functionality and was like, this is so cool. And I don't think I asked the founder any questions about themselves. So
yeah, I kind of joke about this a little bit, but sometimes I almost prefer a crappy product that people are still using, because that just shows how important the need is, that customers are willing to put up with a crappy product.
They must really need that problem solved if they're going through a painful process for it. Yeah,
no, 100%. I remember one of the best bits of advice that's kind of stuck with me over the last like 5-ish years that I've been investing is, if you just look at 10 companies, you're probably going to think 2 or 3 of them are great. If you look at 100, you're probably going to think 2 or 3 of them are great. But there'll be 2 or 3 very different companies. You'll get 1,000, same thing. And so like I think that there is the advantage that investors have that startups don't often get is just the exposure to what a different sort of baseline reference.
What good looks like.
And what good looks like. And I think that is very, very hard for people that haven't seen that or experienced that for themselves. Again, when everyone talks about we're looking for great founders, great, going after a big market opportunity, all those sort of things. What does that specifically look like for you? Or what does that feel like?
Yeah, it's really hard to describe if you haven't experienced it. Like before you meet a founder that is truly exceptional, a lot of founders look great and you're like, yeah, awesome, amazing. But when you do meet that founder or that founding team that is truly exceptional, it is really obvious. So if I can like quantify it a little bit when I'm talking to founders, especially if I'm talking to them separately, I can understand, like I'll ask similar questions and not compare their answers, but understand how their answers complement each other. And if they are on the same page, largely. Also, the learning question, like understanding how do you learn is a really key one, because the ones that talk about doing research, the ones that talk about talking to their customers, the ones that talk about iteration and testing and like building on what they've learned that has been successful and how they'll build on that and explore different avenues. Those are the types of answers that I'm looking for when I'm trying to understand whether a founder has the capacity to learn about, because when you're a founder, there is so much learning that you have to do. Like, this, you've been a founder. You learn at a rate that is toddler level, right? Like my kid learned to go from 0 words to full sentences in the span of like 6 months. That's a whole bunch of learning that happens. And it's the same thing when you're a founder, when you go through this journey. And so I need to know that this is a founder that has the capacity to just soak everything in and then filter. So one of the questions that I'll ask is, how do you determine what is the right decision if there's a conflict between you, or if you're getting different recommendations from different advisors, if it's a sole founder, and the way that they are able to describe to me their filtering process is also really, really telling. So my recommendation to you is that it's probably, if you are a listener out there thinking about investing and wondering like, how do I determine what good looks like? It's really hard to listen to me say these things and like kind of take some of it in as the heuristics and maybe apply that. But my best recommendation is go out there and get exposed to as many companies as possible in various forms. It could be you go to pitch events and talk to founders. It could be you go into a co-working space and talk to founders, or just go to events in general and talk to founders. But the more you get exposed, eventually you will talk to someone that is at that level, and you will be exposed to what good looks like, because it's really hard to describe until you actually experience it.
We're going to take a very quick break from this podcast to talk about one of our partners, Vanta. So if you're building a SaaS business and want to quickly unlock growth and build customer trust, one way to do this is by achieving compliance with SOC 2, ISO 27001, CPS 234, Essential 8, or other in-demand compliance frameworks. However, this process is often time-intensive and very costly. Vanta automates up to 90% of compliance, making you audit-ready quickly and saving you up to 85% of associated costs. And not only that, Vanta scales with your business. With a market-leading trust management platform to help you continuously monitor compliance, unify risk management, and streamline security reviews. You can join over 8,000 global companies like Atlassian, Dovetail, and Indebted that use Vanta to build trust and prove security in real time. As a listener of the show, you can get up to $1,000 US off Vanta when you head over to vanta.com/demo. All right, let's get back to the episode. And I think an important element that often gets overlooked is like, you don't have to be an angel investor necessarily to do a lot of those things. So, I speak to a lot of people that would like to get into investing, but just aren't at a place financially where they're able to do so. I think it's interesting that both of our journeys kind of started off with events and community and a lot of those sorts of things.
And we started investing at similar times too, about 5 years ago.
Yeah. And I think that like, even just with that, because I think, part of seeing what good looks like is just interacting with just amazing founders through the podcast. And you just kind of see and hear a lot of different things and kind of see in just little things how they respond to particular things as well. And I think, you can still add a ton of value without having to angel invest. I kind of started with just joining the dots where founders would reach out to me, and I kind of played the ad hoc matchmaker role between them and a bunch of VCs and angels. And that again kind of told me like, what are VCs investing in? Why are they investing in particular things, or why are they passing on particular things? Why do I get excited about introducing particular companies versus like, what am I a little bit hesitant about and why?
That's such a good one. Like the connection piece is like, when you find a founder that you really want to make connections for, just stopping for a moment and reflecting on like, well, why am I really gung-ho about making a connection for this founder versus the last one I talked to? I was kind of like, oh, I don't know.
Well, I'm curious how much, because I definitely feel like it is an art form. And even just like, James and I, when James was our investment manager for Playbook, one of the things that we sort of realized was we would know very quickly whether we were likely to invest in the company or not. Anything that we sort of had to discuss at length over an extended period of time was just, we were just kind of kicking the can down the road a little bit, where, I think a lot of this is a conviction exercise, even at the start, where you don't have a lot of data points in a company that's pre-product, pre-revenue. I think there is a gut feel element of that which you can't really overlook.
Oh, 100%, especially at the early stage. Like, that gut feel is the thing that drives you. What I think is really interesting is that gut feel can be wrong, right? We've all been wrong.
100%.
And it's just par for the course, right? Like, you're going to be wrong in a good chunk of the time. What I think good investors do is reflect on what was my gut feel at the time and why do I think that gut feel came up for me, and do I need to adjust anything in my own like mental bias or mental patterns in order to be right next time, whether it is not making that investment or whether it is making the investment that you like your gut told you no and you declined that deal and then it turned out to be a winner. Now, of course, there's in our game, there's the power law. And so we expect that the vast majority of companies that we invest in are going to fail. And so it might be that like that was a good bet at the time and my gut was right. The thesis was on point. But every now and then we find ones that where gut was right or gut feeling was there. And you look back and you go, actually, you know what? I missed something. I missed that, this founder and the founders didn't have a great relationship and I didn't ask the right questions and I got too excited about this. So I think good investors trust their gut, but also reflect in order to adjust how their gut reacts to the next deal.
Yeah. Are there any particular deals that you sort of learned from that kind of you made specific changes in terms of how you sort of think about investing?
Yeah, absolutely. Well, the founder one around like not getting too anchored to a product is definitely an adjustment. And I think asking better questions of the founders is absolutely another one. That product demo, I like I said, I don't do product demos anymore because I know intrinsically that like my gut can jump into a product and get excited about something that looks great, and conversely see a crappy product and just discount it. So I know that like my gut is actually not super trustworthy there. Yeah. And so I've like eliminated that from my investment processes. Like generally I don't want to see it. I'd rather anchor more on the founder.
Which is also an interesting point as well, because like sometimes I think we can overcomplicate and just add so much information that we kind of need that it actually clouds our judgment or sees us in a particular way versus it being an actual helpful exercise.
Yeah, 100%. I think also doing reference checks as well. And I hate to call them reference checks, but there's generally somebody that I can call up who is somewhat close to the founder and I can just do a quick, hey, what's your feel on this founder? Whether it's a previous investor or an employee or an ex-boss or somebody who ran a program alongside that founder, there's usually somebody that I can call up. And that can be really great, but also it's like a sample size of one. So that's an area where like, I think I declined a deal because somebody was kind of, like I just got the sense that they were iffy on them, but I think they're doing well now. So I think that's something that like can be great, but also can steer you in the wrong direction if you anchor too much on that.
Yeah. I remember for us, one of the early deals that we did ended up doing quite well, but there was another founder with a very similar business model in a very adjacent industry. They didn't compete, but as a syndicate, we've just always been very conscious of what is the deal flow that we're bringing towards our syndicate members. And we didn't want to be branded or look like we were so early on that we didn't want to feel like we were just giving the same deal over and over again. And so although we kind of loved the founder, loved the market, we decided to pass, and that company is actually doing really well now.
Oh, damn. Was it because you had already brought a similar deal?
Yeah. So It would have been our first and like maybe third deal, third or fourth deal. And so I think we were just more conscious of the portfolio that we were sort of building that early on and the relationship that we were building with our investors, which actually had, again, nothing to do with the company, nothing with how we felt about that company, but was a good reminder of if you talk about simplifying it and just investing in great founders after big market opportunities, then that should be, the winner. But again, it's sometimes you just need to learn those lessons as an investor as well and like look back on things and just go,
Yeah. That's why we call it learning checks for the first few.
Totally. It's a very expensive way to learn.
It is. Though, I mean, compared to doing an MBA for 50 grand, like debatable.
Yeah.
On the expensive side, like arguably this is cheap.
Yeah.
Depending on how big checks you're writing.
I mean, one thing that I definitely talk to a lot of people about, and I'm sure you kind of get this all the time as well, is, I think people that are investing for the first time feel like they have to write a huge first check. And what they're much better off in doing is deciding, like having an investment strategy in place. And that will evolve over time, as we've kind of discussed. But instead of putting 50K into one company, write 5K checks.
Into 10 companies.
Yeah.
Yeah. And syndicates have been a great way of allowing people to do that, right? Like when you and I started 5-6 years ago, there wasn't the ability to write a 5K check. You went to a founder, was like, hey, you want to take my 5K? They're like, no. Great.
Yeah.
Okay. Right. So like the first check I wrote was 20 grand because there was no option to write a 5K check. Now with the proliferation of syndicates, you can absolutely do that. And I would absolutely recommend trying to write as small as possible learning checks, because you're going to learn a lot from those first few. And then also lean in, like don't just write it and then walk away. Like lean in, read the updates, try to answer the asks, learn about what the company is doing and follow them, and looking back and go, okay, well, it's been 6 months. My thesis on this company and why they would be successful is this. Like, have they met that? Are they building towards that still? Or like, was I wrong?
Yeah. I'd be curious to kind of get your perspective on this. Of someone who's starting investing for the first time, I think a lot of people feel like they need to have control over the checks, which makes total sense around it. And that's where I think syndicates make a ton of sense, where you're just getting deal flow and you just get to decide which companies you want to invest in. But, it is essentially a power law game. And so what you're kind of relying on from a syndicate is, instead of you having to convince the founder to take a relatively small check from you, which, unless if you've got a brand or some specific strategic value that you're bringing, it's often more costly for a founder to bring you on the cap table than it is helpful to take your 20K check. I think syndicates are just a great way for you to just learn. And again, I think a big part of it for me was just like understanding, I like this company, why do other people like it or dislike it? And just kind of using that as a reference point, and then having the time to kind of see how those companies are performing, to just refine my own judgment on those things and whether I would have been right or wrong.
Yeah, 100%. There's nowhere else in the ecosystem where anyone publishes their notes on why they're investing in something. Like, it's not like Blackbird or Airtree are publishing their IC paper on the last investment that they did that says like, here was our thesis on why we're investing in this company. But syndicates do. They literally, like you and I, write up notes, like detailed notes on what is the problem? Why do I think this is a painful problem? What is this, like, what is the solution? Why do I think it's addressing it? What is the market size? And like, we go into detail around why we think this is a large market, or why we think that this technology is exciting. And like, this is my personal opinion. I'm writing out my personal opinion on why I'm investing in this company. So it's a fantastic way to learn. And again, this is where you get to like sit next to others who have been doing this a little bit longer than you have and see what good looks like. The other thing to keep in mind is that syndicates generally, you and I, we probably look at like 500-600 companies a year. So the company that we're bringing to our syndicate members is already filtered through 500 companies. Like, I looked at 500 other companies and decided this is the one. And then you're, as the syndicate member, you're maybe looking at, let's say you're part of 3 syndicates. So you might see like, 30 deals a year, and you're maybe picking 3 out of those. So you're filtering from an already very filtered list. So somebody has done that filtering for you.
Yeah. And I think, one of the great things about platforms like Aussie Angels is there are so many more syndicates that are available, so many more sources of capital. I think one of the things that we've been very conscious of is, as a result, because there are so many sources of capital, and knowing that a lot of investors, should and do sort of sit across multiple different syndicates, is how do we bring differentiated deal flow to our investors as well. And so I think that's always been part of our philosophy is, if something is being shopped around to other syndicates, as much as we might like that deal, it's not right for what we're trying to build with our syndicate members, which is, if they've seen it in multiple other places, that's not the reason why they want to come and invest with us.
Yeah, interesting.
We want to be able to sort of give them access to particular deals they wouldn't have access to otherwise.
Yeah. I think I'm more of a like collaboration approach. Like, we've seen a few syndicates that will co-invest in things together. I'm more of the like, well, if there's more people around the table to be helpful, then awesome. But I do think that's a good strategy. If you are thinking about like, how do we make sure that our LPs are getting differentiated deal flow, then picking deals that are not being shopped around to other syndicates also makes sense. So again, there's no right or wrong answer here.
There's no right or wrong. And, I think we definitely take a collaborative approach as well. So like we don't lead deals. We, part of our role is either founders will make room for us into oversubscribed rounds, or if we're one of the earliest investors, we'll use our networks and relationships to help them find a lead or get the right other people around the cap table. I think for us, it's more, there's kind of two sides of it. One is the founders that you're deciding to invest in, and the other side is the investors that you have to keep engaged and keep providing value to and give them a reason to continue investing through you. And so what we've kind of found is, I totally understand from a founder's perspective, it's been a tough market and fundraising is always hard. But like we were saying earlier, compared to 8 or 10 years ago when there were 2 venture funds and no source of capital, there's a lot more sources of capital now. And so trying to think about what's our purpose and why do we exist here for us has always been, what can we bring that's a little bit different or unique, or like, there's some form of competitiveness where unless if you have the ability to write a significant check into an LP, into a large fund, you probably won't get access to it as an angel. And so that's kind of the space that we want to play in.
Yeah. I actually think that syndicates have created a lot of opportunities for investors to get into deals that you wouldn't get into otherwise, because you're not writing a $250,000 check into Blackbird. Like we've both co-invested alongside Blackbird, and that's one of the value of being part of a syndicate, is that like venture fund access to deals.
Yeah. And, I think there's definitely an evolution for people as well on the investing side. So I think people sort of start with angel investing and then go, actually, I am not writing huge checks. It's much easier for me to sort of bring together a group of people. As you sort of write more and more checks, build your relationships in the community, you have more people that you'll sort of co-invest with or share deals with, and all of those sort of things. I'd be curious from your perspective, having seen both the quantity of deals, but also 35 syndicates that you mentioned that are active on Aussie Angels at the moment. What are the similarities between, or commonalities between, good angel investors and syndicates?
Good question. I think the ones that are doing really well, they communicate with their LPs a decent amount. They'll keep them updated. They'll make sure that they know how many deals they're going to run and what that might look like. The other thing that I see is the ones that do well are focused. So they usually have some sort of a theme, whether that is like, we back amazing founders and here's the type of founders we're going after. So it doesn't necessarily have to be like a sector focus, or it could be a sector focus, or it could be a specific technology focus. I think that focus piece really helps anchor investors on like, okay, well, I can get excited about this. The ones that are like truly like, we're agnostic, it tend to not get as much attention when it comes, especially because, we've got 35 of them. So you can go to the directory and scroll through. We've got like 3 climate tech focused syndicates, one that's they just invest in female-led businesses. So having some sort of like a focus area, I think, is one of the themes that we see across successful syndicates. The other thing, and this one's hard to manufacture, is the track record. So I think successful syndicate leads have investing experience. They have deployed their own capital, and they have then taken that experience and that track record. And it doesn't necessarily have to be like exits. For example, like I don't have any exits. Oh, actually, I have one. Just kidding. It's new, so I keep forgetting about it. It wasn't a huge exit. It was like a 17% IRR, which is objectively good in like a short period of time. But that aside, I think it's more about having a track record of getting into deals and being able to say, hey, these are the decisions that I made, whether rightly or wrongly. We all have bad decisions in our past, but I think those are some of the traits: is good communicators, having some sort of a like focus to anchor onto, and a track record.
Yeah, I think that again, one of the best bits of advice that I got, there were a ton. I leaned on so many people when I started angel investing.
That's actually like another thing, is like people, this is a very collaborative activity. Like angel investing is such a team sport.
Yeah, 100%. I remember an investor said, like, you have to be able to say no to deals. If you're literally just saying, agnostic, stage agnostic, like you'll invest in anything, it's very, very difficult to say no to anything off the bat. And so you're just going to get flooded with deal flow, and you're just going to get into decision paralysis between things, because it's very hard to compare. And so to your point, I think it doesn't necessarily, it can be industry, it can be stage. So for us, we're industry agnostic, but very focused on pre-seed and maybe a little bit of seed. So for us, we want to be the first check in. And that's just based off the back of our thesis, which is, I don't think like meaningful de-risking happens for a company until Series B and beyond, but the valuation of company changes quite significantly. And so from an angel investor perspective, when you're not
why not invest that early, right?
Yeah.
You're taking the risk anyway.
Exactly. You're just going to get sort of bigger bang for buck from that perspective. And then that comes with more risk. And so there are ways that you kind of mitigate that risk. But, I think that's where it's just kind of thinking through of like, what is the right approach for you? And I have always loved 0 to 1. But, some people prefer investing a little bit later. And so
when they see a bit of revenue or more customers or a proven technology. Yeah. I actually really like your point though, that like even when there is a little bit of revenue or a little bit of users or a technology that is built, there's not a significant amount of de-risking. Like the vast majority of de-risking happens at that later stage when there is evidence of product market fit, when there is like scalability and actual like repeatable go-to-market motions. So that's a good point. I think that it probably isn't teased out enough. It's like, well, you're investing at a very risky stage anyway. Why not invest a little bit earlier to get the best deal?
Yeah, just to get the most sort of bang for buck from an angel check. But yeah, like again, I think it just comes down to like both. It has to be a personal preference as well. Like if someone said you have to invest into later stage companies, I don't like doing that type of analysis, and like that's also not me.
Then you're looking at like models and financials and like
yeah. And so, I think a big part of it for me also was just like, what are we sort of strategically, what is our advantage? Through the podcast, a lot of people get introduced to the space. And so we get a lot of deal flow through my work at AWS, and even to Startup Vic, I have a lot of connections to like accelerator programs and co-working spaces and all those sort of things.
Yeah, you've got great deal flow, Rohit. We know.
Yeah. So like that was helpful for us from that perspective. But again, it's just kind of thinking about like, what is your unique advantage? And that can be industry, that can be experience, that can be whatever. But it can purely just be, where do you have just access to great deals, and just how do you double down on that?
Yeah. The access piece, I think, is the biggest piece. Is when you first start angel investing, it is unlikely that you are going to have access to good deals. The deals that you get access to, i.e. the things that you are able to invest in, are likely going to be things that weren't able to raise elsewhere. And that's just the reality of it. Now, I think that because of syndicates, you're able to leverage the access of Rohit or myself, but that simply wasn't the case when you and I started investing, right?
Yeah, no, absolutely. And so from the Aussie Angels side of things, like where do you see that heading? Like what's your kind of like goal and vision with Aussie Angels?
Oh man, if you think about the number of deals that were done in the last calendar year, I think Cut Through Angel or Cut Through Venture, I had that at about 435 deals. We did 38 last calendar year, which works out to about 8% of the market. I think there is no reason why we can't get to above 50%, where 50% of the deals in any given year have some portion of their round that go through Aussie Angels via any one of the syndicates. Because we have such a broad number of syndicates and funds that operate on the platform, we get to see a lot of really cool deals. Like there's a hydrogen plane company, there's a fusion company, there's a recipe app company. So like it's so broad, and I absolutely love that. So there's no reason why we can't get to a stage where more than 50% of the deals that happen in this country in a calendar year has some portion of their raise through Aussie Angels.
Yeah. And obviously we've spoken a lot from an angel perspective, which I think is useful for definitely a lot of listeners, but I know that there's a lot of founders that are listening to this. And so, when they're thinking about, raising their first round of capital or just kind of fundraising in general, how should they sort of think about that? And specifically from an angel or a syndicate perspective, from the other side, what should they be sort of looking for in deciding who to bring on the cap table?
Yeah. Taking on investors is basically like getting married, because it's a pretty long-term commitment, and there's money involved. Some marriages have zero money involved, so it's even less. I think as a founder, it's important for you to think about what you need the money for, and because there's no such thing as dumb money. I mean, there is, but at the end of the day, no founder wants dumb money. And so, any venture investor is going to think of themselves as smart money. So when I say there's no dumb money, it's because every venture investor says, yeah, I'm smart money, I'm not dumb money. Like nobody is ever giving you money and being like, cool, do whatever you want with it. They're giving you money because they believe in what you're doing, or because they think they can help, or because they have experience in this, or because they have connections. Like there's always something that comes with it. And so if you have your choice of what is the thing that is going to come with this money that I'm going to get, then think about what is the thing that you want, right? Like the money is the same from anywhere. it's the stuff that comes along with it that changes. And so what's important for you to do at that stage before you go and raise is to think about, okay, what do I need now, like in the near future? What am I going to need in the future? And what skill sets will be helpful? Or what doors do I need opened at some point in the next 6 to 24 months?
I think from a founder's perspective, if your fundraising is hard, first of all, and so not everyone is in a position to pick and choose who they bring on. But I think as difficult as it is when you are fundraising, it is really important, as you said, it is a long-term commitment. You can't kick out investors, unfortunately, once you've kind of got them on the cap table. And so it is really important to make sure you're aligned, or at least instead of just saying yes to the capital, you have done your own due diligence in that way. I think, the best investors will come in and just be a boost to you in a range of different areas. It's net negative if they at least just are on your cap table and get out of the way and let you do your thing. Yeah. I think that the worst case, and I've unfortunately had some conversations with a portfolio company that had a challenge with an investor that also had a number of other portfolio companies that were competitors, and there was just issues around information sharing and all those sort of things. And so that's the worst case for a lot of founders. And so part of that is just kind of understanding, as you said, what do you need from these particular people, doing your own due diligence, understanding why are they wanting to kind of come in, and what does that relationship look like based on what you want out of that as well. And sometimes that could just be having their name attached, just adds a ton of credibility, just opens up a bunch of doors, could help with some press, could help with a range of different things, but just kind of understanding the role and why you're sort of bringing that on is important versus just, again, as tempting as it is, just saying yes to anyone that's kind of offering money.
Yeah. It's funny, and it's a funny TV show, but I actually do recommend founders watch Silicon Valley, the TV show.
I love Silicon Valley.
I love that show. Actually, you know who I met last night is the technical advisor to the Silicon Valley TV show.
Really?
Yeah. Spoiler alert, he wasn't the technical advisor on season 6. And so the whole rats thing being activated, not actually a possibility. Very relieving. But they exaggerate some things, but actually it's quite accurate, and they portray a lot of the real things that go on in terms of when you take investors, what you're inadvertently agreeing to and how they can be problematic to your business. So they maybe go a little further, but it's insightful to understand that dynamic and how it can play out if you make the wrong decision in terms of bringing someone on.
I'm just having flashbacks to the scene where the guy was talking about, I've gone through every single scenario. There's nothing else I could have changed. And then he's like, oh wait, I guess we could have taken some, a little bit less money. And if we took less money, then that would mean that the metrics we need to hit for our next round would be slightly lower and more achievable. And just going through this whole thing, he's like, oh my God, I took
way too much money. And he realizes on the call. Yeah.
Yeah. Which is, again, it's very few companies, especially in this market, are in the privileged position to do that. But thankfully we have seen some oversubscribed rounds, and I think part of being in this market is I think there is still so much appetite from investors to invest. It's just the threshold has changed, but for the right companies, everyone wants to come in. And so part of the discipline for founders as well is just kind of understanding, even though there is capital on the table and raising a bigger round is better for headlines and those sort of things, just understanding what they need and being very disciplined on that is very important.
Yeah, absolutely. I will say that I don't know very many founders who have said, oh, I wish I raised significantly less money. What is the difference between 1.5 and 2? I don't know a single founder who has gone back and been oh, I wish we'd only raised 1.5. I know many founders who have said, oh, we were oversubscribed. Our round was 2.2 million, and we had about 2.5 in interest. And I know many founders who have come back and said, I wish we'd just taken the 2.5 because now we haven't quite hit our metrics and we're struggling to, that extra $500K would be really, really valuable right now. I think the examples of the one in Silicon Valley is where they took $40 million at an $80 million valuation or whatever and wished they'd maybe taken 20. It's there's a scale of that.
Yeah, definitely. The example I'm thinking about in our portfolio is they had $8 million committed interest for a $3 million round.
Yeah, and so that 100%, right? When we're talking on the double scale, yeah.
But I agree. I think on the additional $500K check onto a $2 million round or something is, additional runway is helpful because things are more costly and take a lot longer. And funnily enough, that's actually a lot of, again, conversations that I have with founders as well, especially at the pre-seed stages. I think 300K, which again seems like a lot of money. It is a lot of money in most circumstances, but
When you're trying to pay, you're trying to pay developers, it is not.
Yeah, and so like a lot of the conversations, especially with first-time founders, becomes, you actually, it is just as difficult to raise that much. And if anything, for us, I know that it is like a little bit of a red flag or kind of off-putting if founders aren't raising enough capital, because the bigger risk is actually them not raising enough capital to give themselves enough time to reach the next set of milestones, which means the company dies.
Yeah.
And so I think it's more thinking about not just what is a reasonable amount of money, but genuinely like how much money do you need
to get to the next milestone that changes your valuation? Yeah, 100%. What I think is one of the traits that we really appreciate in founders is this like optimism. Like founders are eternally optimistic. They think the world is they're going to change the world and they're going to have this huge impact, which is something that we look for that, right? We want to invest in that. But that optimistic trait also tends to play against them when it comes to things like this, where they're like, yeah, 300K is totally going to be enough. This is going to happen. We're going to get here. And I'm like, well, I love the optimism, but also I've invested in 32 companies now. I've invested in 8 funds. So I've seen indirectly another like 60-ish companies. And I love the optimism, but the reality is that it's probably going to take you an extra 200K. Why don't you raise that?
And, that is part of the feedback process as well, is like, how willing, to your earlier point, are founders of being able to take and filter that particular feedback, and how stuck are they on particular ways of kind of thinking about things. Again, like I think there's definitely ways that like we've found to sort of push on founders to just understand like how do they think and take on advice. Yeah. It is also not, by no means should you be building a company for investors. So just because they say something
doesn't mean you have to
go and do it. That is absolutely not the recommendation. But I think, part of, again, the benefit of seeing a lot of things in the market is just kind of understanding that and understanding sort of what they will likely need and being able to see around corners for them.
I think there needs to be a level of digesting the information. Like if I am putting something out there to a founder to be like, well, look, from my experience, this is what I've seen. And they're like, that's wrong. Or, well, that's not going to happen to us. To me, that is different than if they're like, interesting, I'd love to understand. Maybe they ask a couple follow-up questions to understand the situation better. And maybe they don't disagree or agree with me in the moment, but they take that away and they may decide later to make a different decision. That to me is like an example of what good looks like. It's like you are able to really try to understand the advice, for lack of a better word, that I'm putting out there, and then still make a different decision. I will back you any day of the week on that one.
Yeah. Yeah. A great hack for me that I've seen founders use is if I kind of have that conversation, they're like, okay, great. Who should we speak to write like bigger checks in this particular round? Like if we've just been talking to angels, like who are the VCs we should be speaking to and those sort of things as well. And so that kind of puts it a little bit in my corner to help them on their journey. But I think, you kind of raised the point about optimism as well being super, super important. I feel like there's always like checks and balances with everything. And so how do you weigh up the blind optimism with actually the ability to execute?
Yeah, that's a really good question, because we do like optimism. I don't like the term blind optimism. So maybe that's like the line. It's like, I need to feel like you are optimistic enough, but not blindly optimistic. And I think that probably gets measured in a number of different ways, and comes back to me what we were talking about earlier about that like gut feel, and like, do I feel like your optimism is somewhat based in reality? And so it's maybe asking questions about, what are your thoughts around how you actually capture this market? Have you thought about what it means when this particular trend happens? Or what are you seeing in the market that's influencing this aspect of what you think is going to happen? And then evaluating their answers based on that. And again, I think it comes back to if they're very dismissive of my observations in the market and saying like, well, we're not worried about that, or, well, we haven't seen that, then that indicates to me that they're not digesting new information in a way that is going to be helpful for them in the long term.
Yeah. I think one thing that we discussed a lot is internally is, we've been fortunate to back a couple of founders that are going again after quite significant wins, which, is a particular reference point to go, these founders have at least executed in the past. There is some level of their kind of background that you kind of check. But one thing that we kind of keep coming back to is that's a very easy thing to kind of tick. How do you identify those founders with their first company versus relying on it being the second time round?
Yeah.
And I think one thing that we have noticed as a common thread around, especially around founders that we get excited about, is what we call like an unreasonable amount of progress or traction. But that doesn't necessarily need to be revenue or customers. That can be, I think a large part of that role of early stage companies is like, how do you just become this magnet for great talent, for people to just want to say yes to particular things? And so that can be,
I think
incredible.
the alphas are calling that Riz.
Yeah. Like how do you convince an incredible advisor to come on board? We had a portfolio company that had one of the big four banks as their sort of proof.
Like the whole company, just the bank?
Just the bank, just the proof of concept. And as the first sort of proof of concept customer, and the CEO, if that was willing to like kind of go at bat and be quoted around them and those sort of things. And so there's just, again, signals of just, you shouldn't have these things kind of happen, but part of that ability for a founder to kind of, you know, with very limited resources, with time, just like what's the velocity and just momentum that they can sort of build around them are just very like signals that we look for in the absence of revenue, a product in market, those sort of things for the stage that we invest in.
Yeah, I love that. Like an unreasonable, like you shouldn't have this. It's unreasonable that you have that person advocating for you or that like excitement around what you're doing. I love that.
Yeah. Sender is the OG startup accounting firm in Australia, catering to all stages of your business life. If you're busy running a business, you don't always have the time to do your own books and forecasts, and instead you can fully outsource your finance function so that you have the time and resources back to do what you do best, which is growing your business. They have a dedicated focus on founders, funds, and startups, and have an experienced team that can help you with everything from managing your tax to balancing your books to even helping with your exit strategy. I trust and use them with all of my businesses and can't recommend them highly enough. To find out more or to speak to Gareth and the team, head over to sender.com. All right, let's get back to this episode. And so you kind of spoke a little bit about, you know, founders and, you know, essentially and investors and co-founders. Essentially, it's like a long-term relationship, really, or a marriage. I know you and Tom are co-founders.
We are, yes.
But also partners as well. What is that like for you guys in building, deciding to start a company together? Because usually I think the dynamic is one person's like, you go off, do the crazy thing, I'll keep things safe. Both of you decided to kind of go head first into the craziness of startup land in the same company. What does that sort of look like for you? Because again, you know, I think that's something that a lot of people potentially kind of like grapple with in terms of like that dynamic at home.
Yeah. I think it was less a decision for him and more of a like, I dragged him into it because I was like, I need to start this company. And also I don't have the financial experience to do that side of the business. So you're going to do that, right? I started the company, so now you kind of have to. But no, you know what's funny is that I'd say 5 years ago and earlier, the concept of investors, there was a lot of hesitation and concern and worry about like, oh, you know, I don't know if we want to invest in like a partner co-founding team because like, what if they break up? And it was more taboo. Whereas now we've seen a lot of success stories from partner co-founding teams that it's kind of flipped the other way, that like when I tell them, oh, my partner is also like, I kind of joke, I'm like, oh yeah, he's my partner in life and business and baby daddy. And that always gets a laugh out of people. But people actually have a much better reaction to that now because we've seen it be successful several times. But honestly, for me, there's no one else I would trust with the other half of my business. And we work so well together as a team in the home that it really just like, it flows very well into working together on a business as well. I know that that's not the case for a lot of people. And I often will get the question from my friends about like, how do you work with your partner? How do you work with him on a business? Like, don't you get frustrated? Don't you just want to like, you know, punch him some days? And I'm like, well, yeah, maybe some days, but there's no one else I would trust more. Yeah. And the fact that like we are able to have some really, really frank conversations and like honest conversations with each other, but then also like brainstorm in the car while we're on the way to, you know, swim class for our daughter or on a road trip. And the brainstorming opportunities are just so much more that I feel like we get a lot more done. And we're just such a good team. And, you know, you talk to our employees, and I think that they also feel that it is a great dynamic. So I think it's one of those things that it's not for everyone, but for some couples it absolutely is. And we just happen to be one of those.
Yeah. I had Adrian from Mr. Yum on the podcast a while ago. And we were
see, that's another like, success story, right?
Even just like he was kind of
like Cliff and Mel, like we have seen this. There are winners.
Great reference points to have. Yeah. And I think one of the stories that he was telling on the podcast was like they were in Italy and just like having this huge discussion over wine, and they decided to kind of flip roles for each other, and like even just kind of them understanding those sort of things, like it just kind of changed the dynamic. And there were particular conversations that they would have that, you know, even if you have a co-founder, it's a little bit difficult sometimes to be that frank and have those types of conversations. But I guess with a partner, like, you know, you have that inherent amount of trust and those sort of things that you can just kind of like take things to a different level. Like you said, not for everyone, but for the right type of relationship and the right dynamic, it kind of makes a ton of sense.
Yeah. So yeah, we've worked really well together for the last 2.5 years on the business, but also just in life. Like I think it helps. We've been together like nearly 12 years now. Yeah. So that was one of the things I think we get asked that a lot. They're like, how long have you been together? And I'm like, yeah, like 12 years. So like it's, I mean, I do know couples that have been together 25 years and end up breaking up, but I think there's a level of trust there that like we've worked through a lot of the hard things. We know how to have hard conversations with each other. And even like a regular co-founder relationship, right? If you have a conflict and then you go home, you're stewing on that, you don't have a chance to like talk about it, and then you come back and you have to like sit down and have these awkward conversations. Where with us, things just get addressed right away, because if they don't, like, it's not like I can give them the silent treatment throughout dinner while we're trying to feed our kid or like get ready for bed. Like there's just no option. So like we just address things right away and we move forward, and we've gotten really good at that.
How do you find that, you know, separation or like,
no, we're terrible at separating work and home life. No, there are often conversations about the business at the dinner table.
Well, Alex from your team mentioned that as like driven and ambitious as you are, you're also like a very sort of present and gentle parent. Which I thought was very nice of her to say. Lovely thing to say. But yeah, I guess like how do you and Tom sort of find that dynamic? Because you've got how old is your daughter?
She's nearly 2.
She's nearly 2. So I don't have kids. I can barely take care of myself. But like, you know, I hear from a lot of friends that have kids just how challenging that is. And
it's hard.
Doing that plus a startup is a lot to kind of take on. So, you know, and I'm sure that there are listeners to this that are in kind of similar positions or about to be in similar positions. Again, everyone's approach is slightly different, but like any advice in terms of how you sort of think about that for yourself, or how you frameworks, things that you guys put in place to just make sure that you don't let sort of one thing over index the other?
Yeah, I mean, objectively, I probably work more than, you know, maybe I'd like, or maybe the average parent would like or should. But I actually personally think I have a great work-life balance. And we were talking about this at the Venture Down Under conference, and everyone at the table said that they had poor or like okay. And I was like, I put my little sticker on the good tab. That's awesome. And someone asked me like why, and I was like, you know what, part of it is just changing my perspective and being like, you know what, this is what good looks like for me right now, and I believe that this is the ideal scenario for me, and I'm gonna say that this is good. Maybe it's not as good as it could be, but I'm calling it good. I think part of it is about creating a really good team. And so Thomas and I have spent a lot of time learning how to be very good communicators, and you know, we still have moments, but we try to communicate really well, and that's really important. I think it is a scary proposition. So I was pregnant when we raised. We raised at the end of 2022. Wow. We closed our round, and I basically gave birth like 4 weeks later. So I was very pregnant while I was raising, and I was actually the first woman to be featured visibly pregnant in the AFR on the front page of the tech section. Oh, wow. Which was kind of cool. And I mean, it wasn't the best headline, but I was happy to be the poster child for pregnant female founders raising. So I think my advice and the things that I would encourage you to do if you are in a similar position is to think about how to structure your life, to put the things in place that you need to be successful. So, for example, I chose to get an au pair instead of putting my child into daycare because I wasn't willing to give up breastfeeding in order to go back to work. So I took a full 3 weeks off after I gave 3 weeks. I know, a whole 3 weeks. But I was able to go back to work while also maintaining my own breastfeeding journey because we decided to hire an au pair instead of going the childcare route. So thinking about like, what is the life that I want to build? And then what are the support systems that I can put in place in order to make that happen? And then being very, very communicative about that. So like Thomas and I, we plan out our week every Sunday night. I go through like, okay, well, what does our week look like? What hours does the au pair need to do? What events do you have? What events do I have? I try to put a lot of like support things in place. So we do a lot of food prep. So like no one is ever having to make dinner because we've food prepped either when after she goes to sleep or like on Sundays. So these are just examples of like how I've put support in place to to live the life that I want to live. And also, for example, I brought her in the very early days, the first like 6 months. You saw me at an event. If any of you have seen me at an event,
yes.
you saw me at events. I just had a baby on me. She may or may not have been on my tit, but like I had a baby, and it was fine because that was the life that I wanted. I wasn't willing to give up the events that I went to. And of course, you know, if one of us was really sick or but like you make exceptions, but on the whole, I continued with the things that mattered most to me because I set up my life ahead of time. I was very purposeful about thinking about those things.
I think, you know, what you just kind of said about just being very authentic to what work-life balance, what is the life that you want? It's not trying to live up to other people's expectations or feeling like you need to have balance in a particular way. Like if you're happy with those sort of things or have a very clear understanding of that, I think that's half the battle. And then part of that is figuring out what that sort of looks like and then putting the right, as you said, the right structures in place to enable you to do that. I wanted to finish off on a story about you, which I kind of learned from both Alex and Tom when I spoke to them, which was you have a very strong distaste for waste. I've heard, and that you sort of drive around picking up toys and just kind of left material
redistributing them.
Do you want to share a little bit about that?
Yeah, this started, we moved to a very affluent neighborhood called Northbridge on the North Shore. And there was one weekend where I noticed that there was like copious amounts of brand new toys, nearly brand new toys, just sitting on the sidewalk or on the verge of multiple houses around us. And as I'd go for a walk, I'd be like, oh, sweet. Like, look at this walker. Amazing. Like, Winter will love this. I'm like, oh, amazing. Like, here's a soccer ball. And I think that day I came home and I had like my arms were full of stuff. And I was like, Thomas, look at all this stuff I just like found on the side of the road. And he was like, oh yeah, I think it's like council cleanup. And I was like, what is this council cleanup thing? And so I Googled it and I found that like there were weekends where the council says, put all your shit out on the side of the road and we'll come pick it up. And I also read during that research was that 100% of it goes to landfill. And so my heart sank because I just kept thinking about all of that virgin plastic. And these are like literally, especially in my area, like some of these things are just brand new toys. For example, recently I picked up a McLaren push car. It was this giant plastic car thing that was branded as this orange McLaren. It was still in its box. It had not been set up and put together. It was still brand new in the box. And so when I read this, my heart just sank and I was like, I just could not stop thinking that night. I stayed up all night just like imagining all of this plastic going to landfill. And so the next day I literally got up and I like went and I got in the car and I drove around and I like picked up more stuff and I brought it all home. And then I was like, crap, what am I going to do with all this now? I've saved it from landfill, but what do I do? So at first I started posting it for free on Facebook, but I found that if I list something for free, I'd have 1,000 people reach out to me and then like half of them wouldn't show up and it just got to be way too much. So instead I was like, oh, well, what if I just list it for $5? So I listed something for $5. Someone messaged me, they came and picked it up. It was done in 5 minutes. And so I just started on this journey of like every few Sundays I go out, I pick up a whole bunch of mostly children's things because that's what I'm really familiar with. Yeah. I pick them up, I store them in my basement for a few days. I take photos, Winter goes to sleep, I take photos, and then I list them for $5 on Facebook Marketplace. And I am a total crazy person. Thomas is like, oh, you gonna go dumpster diving today? I'm like, no, but yes. And yeah, so I save things. Yeah,
save things, I guess like, repurpose a lot of things that would otherwise go to waste and, hopefully go to happy homes around those sort of things as well. Or, give toys to kids that like may not necessarily have them, which is amazing.
I'm actually this holiday season, I'm making boxes. And so when people are like, oh, can we have donations? I'm like, cool, this is a box for a 3-year-old girl. So hopefully that will save a few people's Christmases.
That's amazing. Well, if there's anything, again, our listeners can help on the donation front of things. If you do get something up, let me know and we'll share that out as well.
Oh, thank you. Honestly, I think just think about what you're throwing away. If you're putting something on the curb for a council cleanup, it is going to landfill. Take a minute, take a photo, post it.
Yeah, amazing. Cheryl, I do know you've got a plane to catch.
Yes, I do.
So I'm not going to keep you any longer because we can talk for hours, but thank you so much for coming on and being so open. For anyone that wants to find out more, say hello, get in touch, what's the best way for them to do that?
Email is great. me@cherylm.ca. Yes, that is .ca. I am Canadian originally and I have not changed my email since.
Perfect. I will make sure that link goes into the show notes. Cheryl, once again, thanks so much for coming on. It's been a pleasure.
Thank you so much, Rohit.
Cheers. Thanks for listening to episode 201 of the Startup Playbook Podcast. As always, full show notes from this interview will be available at startupplaybook.co. I'll be back next week with another episode, but in the meantime, if you enjoyed this interview, please don't forget to like, share, and subscribe. As always, thank you for tuning in, and I'll see you next week.